Welcome to Power Charting. This is the first episode of 2021. My name is Bruce Fraser. I'm your host. We're going to talk about big investment themes today. And we're not going to get through everything, but we will give it a good start. So to begin, I invite you to go to Wyckoff Analytics and watch the weekly Wyckoff market discussion that Ramon and I do every Wednesday afternoon. We conducted one yesterday, the first one of the year, and it was really an outlook for 2021. If you go to the website there at the top of the screen, you can go right into the Wyckoff market discussion page, click on the recording and watch it. And I think it was just a great session, good energy, covered a lot of really good material. And if you're at all Wyckoff oriented, I think you're just really going to enjoy it. Also, Ramon has just started his teaching cycle. You can go in and watch his first classes on a recording, and those are also on the website and on his YouTube channel. And then also consider signing up for his classes because they are just exceptional. So have a look, check it out. 3 IPO booms. We've looked at this chart before, and basically now these are 3 IPO booms that I've been through in my career. I believe that we're in the 3rd one right now. This is a Nasdaq composite monthly line chart going back to 1978, which is all the data that we have. 1983, there was an IPO boom. And it was pretty spectacular. Not many people were around then that were able to experience it. I was actually in the valley at that time, so I saw it up close firsthand. And so the thing that, and then you'll notice that after the boom occurred and concluded in 1983, there was an 8-year period of time when growth stocks basically lagged and underperformed. Blue chip type stocks, value stocks, income stocks performed better. And so the Nasdaq continued to go up per se, but on a declining relative strength basis to these other areas of the market. So growth does not always lead. Then you can see that starting in around 1991, that there was the beginning of an important takeoff in the growth stock theme again. And this went all the way up, 9-year expansion, went all the way up into another IPO boom. This was the .com boom, and it was truly crazy at the time. And a top was built. This was a distributional structure that resulted in a massive bear market for the growth stock .com type stocks, and you can see the relative underperformance was just spectacular. This resulted in about a 9-year underperformance for this segment of the market, and then starting in 08-09, the growth stocks started to take off again, and we are in the midst of that now. 2020, this is really accelerated, as you can see here. Now, I don't think the IPO boom is over. I believe that there's still potential for more to come in the IPO boom, but what I want to really emphasize here is the IPO boom is the final stage of a growth stock expansion, and then you get rotation. My expectation is when the IPO boom is over and it turns down, it's going to turn into a rotation into other areas of the market, not necessarily a bear market. And ironically, that was really the case in 83, 84, where the stock market really just didn't miss a beat and just kept going. And here you had a long-term decline in the Nasdaq stocks, but the senior blue chip names basically had a very subdued correction, minor bear market before they started to really dominate. Okay, so here is just another look at this. you can see that what happened is that there was in 83, there was this blow off in the IPO and growth stock area, and then a reversal, and this reversed the relative strength away from the Nasdaq comp names towards the blue chip names as measured by the S&P 500. And so you can see here that the blue chips are leading thereafter. And it was just a great time to pursue rotation. And that's really the point I want to make here is that this is an exercise in identifying important rotation as it occurs in the markets. We think the IPO boom has a ways to go. I'm going to show you why, but also that rotation into other areas of the market that are getting ready to be strong is really an important characteristic of investing in stocks. And so keeping that in mind, one more look at the Nasdaq. Let's look at the current period. This is 2010 to the present. This is up through January 7th. And you can see here this really just epically long uptrend in the Nasdaq. We're using reverse use of trend lines. Look at all of the touches here that we have throughout this advance. And now we've thrown over the top of this, which means that the acceleration of this theme oftentimes results in a buying climax situation. Now, this acceleration can go on for a period of time. Look at what's happening with the relative strength. Relative strength of the S&P 500 in 2020 has just become epically strong. And off it goes in this very, very steep advance, which there's no telling how far this can go. Remember, in 2000, there was a distributional top when that IPO boom ended for the Nasdaq comp, the Nasdaq 100, et cetera. We would be looking for that. We don't see it yet. But we are seeing that there's this incredible acceleration. I say this, that as long as the relative strength of the Nasdaq comp is continuing to point upward, I would consider this a condition that the institutions will be getting positive feedback and continuing to invest in this area of the market. Now, why is this likely to continue? I thank Roman for this chart. He constructed it. We used it in our Wyckoff market discussion yesterday and in the past. This is a great chart because look here. This is a 1 hour point and figure that Roman created, and you can see this classic accumulation structure in the Nasdaq 100 futures. And here is the count all the way across. Beautiful construction with a spring and a sign of strength and a backup. All these essential characteristics of a Wyckoff-ian base, Wyckoff-ian accumulation. What's the count objective? 15,400 to 16,100. Here's a beautiful uptrend with a buying climax that came in the fall. And we talked about that at length, and we are now in a range-bound structure, knocking on the door of the top of the range here. Well, this count is a reaccumulation count. Reaccumulations are classic aspects of the Wyckoff-ian method. We count these with point and figure. We look for confirmation of the reaccumulation point and figure count objective to the original accumulation point and figure count objective, and look what happens now. This count in the reaccumulation confirms the accumulation count. 15.8 to 16.7. They are very close to each other. That is often the moment, the time. It's a timing tool, very much championed by Dr. Hank Pruden, is that once you get the reaccumulation count to match the accumulation, and they both go to the same price objective, that's often when the uptrend is confirmed and starts to initiate into a new trend, a new uptrend that appears to be where we are right now. And so we will be looking for the potential for the Nasdaq 100 now to work its way up to this higher count objective on both of these levels. Now, looking at the decennial pattern, this is kind of a tool that we're going to use for the next 10 years. And you're going to get 10 years of power charting where we're just going to look at this chart. We just completed the 0 year of the decennial pattern. This is the 80s. This is one of the better examples of decennial pattern. Every 10-year period has its own unique twists and turns, but it's remarkable how much the decennial pattern seems to influence the trends of the market. The first 3 years, the 0 year, 1 year, and 2 year, tend to be the years that are cyclically the weakest for the stock market. Now, we've had generally a very good uptrending year, surprisingly, after a steep correction in 2000. We had a correction also in the first quarter in 1980. But notice the downtrend characteristic of the 0 year. There's a downtrend characteristic of the 1 year, and then the 2 year tends to be often when the low is made. Here we are, we're in the 1 year. I think this could very well be a model that we follow in the 1 year, and that is that we have a trading range for the first half of the year. Maybe a little upside pressure in the market in the first quarter, but then sideways into the middle of the year, and then potentially this is some kind of a minor distribution and then a fall off into the end of the year. I think that's possible and consistent with the decennial pattern. So we'll consider that, and of course we always confirm our hypothesis with tape reading. And so we're just not going to just take this as the holy grail. We're going to make sure that we can confirm this with price action. Here are the 3 prior periods. We now know that the president is going to be Joseph Biden, and this is going to be a change of party, a new president. So 1960, 1980, 2000, and now 2020 all have the same characteristic in that there is a change of party and a new president in each of these 4 examples. Now notice that what we get in the second year, the 2 year of the decennial pattern, or in this case, these 4 examples or 3 examples so far, is that we get a low in the second year. So they're all a little different. We had a pretty good uptrend for the Kennedy 61 year. We had a sideways market for the Reagan 81 year for at least the first half. This really followed the pattern quite closely, and then weakness into the end of the year. And then in the 01 year, remember that this was during the very severe bear market for Nasdaq stocks and growth stocks, as we had sort of a volatile sideways for the first half, weakness into the fourth quarter, end of the third quarter, and then a rally into the end of the year. So, but weakness shows up into the second year, and in all cases, a good low, important low is made in the market. So we'll watch for that. Here is a very interesting chart. This is Bitcoin on the bottom, gold on the top. And so and also gold, these are monthly bars. These are weekly bars for Bitcoin. This is about 4 years of data. This is about 11 years of data, 11 to 12 years of data that we're looking at. So there are different amounts of time. What's so fascinating is the way that both of these markets climaxed 2011 for gold and 2017 for Bitcoin. They both consolidated, had a distributional formation, and then declined for a period of time into a large cyclic accumulation structure that resulted in a new important uptrend. And so here is very close, similar looks to both of these structures, and then higher lows here and an important uptrend in gold up to the prior highs, going all the way back to 2011. And then in the case of Bitcoin, back to the 2017 high, and then a breakout. So Bitcoin is actually moving more aggressively, shorter time period, but still a very big structure. So these are two very interesting charts that we're looking at that seem to have a family resemblance, and both of these assets are assets that benefit from currency issues. So we're going to look at the currencies here in a minute, but both of them are alternative currencies. And so this may be the commonality of these two themes. Now, what I've done here is I put silver in. Silver actually is the asset that has generally been lagging, but notice there's a spring that has occurred here in the 2020 COVID lows, and then a near vertical advance in silver as it's jumped out of a very large accumulation structure going all the way back to 2014. So here is silver actually lagging and then all of a sudden coming to life and having this near vertical advance. And we also can see that Bitcoin is having a very strong period also. Now the time periods are different between these two because again, with silver, we're looking at monthly data again, like we were with gold. But very interesting because silver has jumped out. It's now consolidating and has backed up to old resistance, which is along here. And old resistance becomes new support. Silver is now paused and looks like it is ready or could soon start to work its way up to its prior highs back in 2011, which is around $50. So we'll watch that very closely. Now let's talk about yields in the Treasury market. Here we're going to look at 10-year yields. And you can see the chart on the left, this incredible decline in interest rates 2018 to 2020. Just a collapse of interest rates from around 3.2% yield here down to under 0.6, nearly 0.5 yield at the lows. So very close to a zero yield environment. Then we look and see the potential here for an accumulation type structure, because notice that after the climactic low in March, there is a sharp automatic rally. So selling climax, automatic rally, secondary test, range bound condition here across these areas. And we see that now yields have worked their way back up to near 1% and are at the top of this resistance line. And it's trying to work its way up to this higher resistance line at about 1.2% yield. Well, let's look at the point and figure, because the point and figure often gives us a perspective that is different and valuable from what we see in the line or the bar chart. So here is the potential distribution in the line chart, but now we look over here. Well, we can count point and figure on yield just as we can count point and figure on price. And here we see that if we take this count all the way across from the breakdown of this distribution area and one last attempt to rally up under support here, and it rallies up into this zone where it's called rallying or touching the ice from underneath. It's a very vulnerable place for a market to be, is underneath the ice. There is a vertical free fall event that occurs after that. We take this whole count, which is the area in yellow shading, 33 columns, and we take that count. It gives us a full 1.98% yield decline in the bond market. So isn't that interesting that point and figure can give us this estimation? And so here we see that the range, because of this large range up here, this range of yield is 1.26 down to 0.62, with the midpoint being 0.94. Well, the 0.62 was exceeded in the selling climax, and then the automatic rally occurred by just a few boxes. And often selling climaxes do run through the extreme point and figure count temporarily and then reverses sharply back up into the count area. Exactly what's happened here. Now, I have counted 3 segments here. These 3 segments across are rather large in their formation, and you can see that segment 1, or segment A, which is 1.02 of yield, counts up into this area here, 1.54 to 1.92. That is the area of the first segment count. The second segment takes us up to this area, 2.14 to 2.52. But if we take the entire area all the way across, 35 columns times 3 times 0.02, which is an ATR scaling convention, we can see here that we get a count 2.62 to 3% yield. So there is that much yield potential to rise in the accumulation structure as it exists. Now, here's the thing. It may not be done yet. There may be more. It's made a sign of strength where it's come out of this area. So far, it's making higher lows throughout. It's pausing here. It may just continue to go up, but also there's the possibility that it could come back in one more time and make what's called a last point of support. So we'll be watching this closely, but there is a very real potential for yields to go up significantly from the level they're at. Now here, this is a redistribution, same concept that I showed you on the Nasdaq 100, and right where this count was ready to resolve into a new decline in interest rates was almost exactly the same range that we had from the big distribution count above. So this is redistribution confirming point and figure count. Seems magical, but it works. Now, here are 3 segments in the gold market. This is the Spider Gold Shares ETN, I guess you would call it. 3 segments are counted here. The counts could actually be extended larger, but look at what we have. I'm a little short on time, so I'm going to go quickly. We have a count that went 192 to 202, and as you know, I have been showing this chart for a couple of years now, so this is no surprise to us that gold has launched out of this accumulation area. I actually wrote a blog right here on that pullback to that low. But if you look here, You can see it count up to 192. Well, look where we went. 194 was the final high count. So off it goes upward. By the way, this was a confirming count right here. And so with a climactic surge at the end, now we're about 8 columns into this. Now the question becomes, how many more columns do we need to then generate a point and figure target that would get us up to the 240, 250 area? We need at least 4 more columns of count. 4 times 6, which is 3-box reversal, 2-point scale. So each column represents 6 points. So we need at least 4 more columns to get to the minimum count of 240, and maybe more. So this accumulation structure may not be done forming yet, and it may have more time to go if it can even get into gear and go up again. The other thing is, look at this larger count, 312 to 322. So there's huge potential still yet in this accumulation structure for gold. Turn our attention to CRB. Here is 2 counts, a distribution count from the last point of supply to the high. Look at this, almost a perfect hit, went right into the middle of the range. I've taken the more conservative count here, accumulation-wise. CRB is a measure of inflation. This is actually a good sign. CRB starts to take off. It demonstrates that the economy is getting stronger. There's demand for goods, and that's also why interest rates are at risk of rising, is because there's demand from the real economy for loanable funds to borrow money, and the cost of borrowing money is interest rates. So interest rates appear to be rising. CRB appears to be rising. These are both good evidence of an economy that is getting stronger. So here you can see we have a count goes 180 to 212, and there's still further to go for the CRB, but it is up and out. The other thing is that we might want to widen this count out to give it even higher objectives, but we take the more conservative counts and watch for the ability to get into those before we then consider the larger, more aggressive count. Here is just a line chart for the CRB, and I wanted to point out that relative strength against the S&P 500 is just starting to try to emerge into an uptrend, and after a multi-year downtrend, that could be a sign that CRB wants to be leadership again. This agriculture fund is one that we're actually trading this real time in the Wyckoff market discussions, and I just wanted to point this out because we look at this every couple of weeks, and we look for the actual entry places that we're making in real time in this as it goes up. And you can see, I think this is just real textbook. The only place we missed was on the test of the spring, but these are all classic Wyckoff entry places, tactics, strategy. These are the things we talk about in the Wyckoff market discussion, and we hope that you'll consider joining us. Okay, so last I have, and I'm going to just tease you with this because next week we'll talk about the dollar. The dollar, lots of talk about the weakness in the dollar, but it's coming right down into an important long-term trend line that should provide important support. And also here you can see it up close, point and figure count here. We are in the range of fulfilling the point and figure count, the smaller point and figure count for the dollar. And with that, I'm going to say goodbye. Thank you for being here, and I will see you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.